think I finally got YouTube to work properly. Man, is it buggy. Just trying to see if I can get everybody here. All right, looks like we got it. Alrighty. Get rid of that dystopian dark synth. Sorry about the glitch. I'm telling you, this new YouTube thing is glitchy. So I started the right stream and then it threw out an old stream instead of starting the correct stream. I don't know how it does that. But anyways, let's go. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. U.S. stocks may see initial strength on optimism about end of government shutdown.
Fed's Daily, looking to see if productivity gains continue. How the economic data calendar might look if the U.S. government reopens today.
Oil prices rise on optimism over potential end to U.S. shutdown. Portugal trade gap narrows in September. Fed's Daily. Inflation so far has been pretty contained in goods prices. Oil steady after U.S. shutdown talks advance. Oversupply concerns persist.
Lithuania inflation rises to 4.1%.
Kiwi dollar, U.S. dollar recovers from 7-month low on Chinese inflation. U.S. budget deal.
U.S. dollar Canadian dollar technicals. The U.S. dollar Canadian dollar continues the move to the downside and tests
Yeah, I bet you have sound now. Gee whiz, YouTube. Come on. What's going on? All right. So now do you hear me? Yeah, Jiminy Cricket. And now I don't even see anyone responding into the chat. So So anyways, if you don't know what's going on, about 2.5, 3 weeks ago, YouTube changed their process and it just doesn't work very well. Yeah, often it just streams to the wrong stream key, stuff like that. So, anyways, I said the I said the disclaimer. Let me remind you that trading is risky, not appropriate for everyone. Past performance, good or bad, is not necessarily indicative of future results. You stay small, stay humble, focus on the long term, never risk money you can't afford to lose. Sound is very low. Now it's going to be better. Cool. Yeah. So hopefully you heard the headline news. One of the things, oh, yeah, and ready to go. So you can share the YouTube link. I don't even, it's not even streaming. I guess this is it. Copy. Let me get this for JGB. All right. So, anyways, everything's all messed up, but we'll recover here. So then you got an update on the news, maybe an end to the government shutdown. So that would be risk on. Nothing really on the calendar today, really, that should be terribly frightening. If you're logged into traders.com, this is, I think, is this the current one or is it the last one? Current. So that's right now. So maybe that's a quick way of getting to the live stream. Want to focus on the new risk radar, and then we'll go into technical analysis. Okay. It's doing a lot of data crunching. Remember, this is a database, not a website. It's simple and stupid. No way. Now everyone, hang on. It's been fixed. So, hang on. Let me just, all right, I'll load it again. So this is a new feature in TRADARS. We used to have a risk gauge that looked at 8 different assets on 3 different time. And it was very binary. It said, well, if the dollar is strong, that's risk off. Give it a -1. If gold is strong, that's inflation flow, that's safe haven, count that as risk off. So that's a -1. If the stock market is up, that's good. That's risk on, give it a +1. Very, 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 very simple algorithm. Our new scoring process is incredibly sophisticated. There's different weightings, different time frames, different weighting on asset, but different weighting on time frames as well. I'll explain. And if you really want the details of how we do our calculations, it's right here. So we track way more assets. So for example, let's say money is flowing into high yield junk bonds. Is that risk on or risk off? Money is flowing into junk bonds. Risk on, baby, risk on. But let's say time goes by and in a week or two, money is flowing out of junk bonds and into investment grade corporate bonds. Is that risk on or risk off? That's risk off. So now we're doing that. We're doing safe haven flows inside the bond market, but we're also tracking the entire yield curve. Oh, yeah. Tracking all the major stock markets around the world, major commodities around the world, but we're creating our basket weight how do you say it, non-linear? They're not non-equal weight. So for example, volatility matters a lot to whether things are risk on and risk off. The stock market matters a lot whether it's risk on or risk off. If money is flowing into junk bonds or flowing out of junk bonds, that matters a lot. Okay? And then you take short term, medium term, and longer term and weight that data different. And then you have a positive or negative score, which gives you an outcome between 0 and 10 or 0 and negative. Here's a little thermometer. And so doing all of that right now, so you're like, well, Wayne, what's the big deal? Well, there's hundreds of variables to create this score. And we're tracking all the different traders and all the different asset classes around the world and discerning risk on or risk off. Risk on or risk off. Yeah, pretty cool. Very, 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 very sophisticated. It's been very risk off, okay, recently, like in the last week. Quite risk off over the last 30 days. Friday was sort of mixed, slightly positive. But then when you put them together and weight, you get this score of 2.73, which kind of shows that it's not as bad as it was, but it's bad. Cool, right? So this is our new risk gauge. Very, 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 very powerful. Now to take it to the next level, if you subscribe to our higher end products, if you unlock AI, our AI named Aiden goes way beyond the quantitative analysis. So this is a much more sophisticated algorithm, but it's not AI. But it's very, very sophisticated to the algorithms we used to have. So it's a massive upgrade for you to read the market. But then the next level up is for then to add AI, and Aiden will look at all of that. But then also, because it's in Aiden's mind, if I go to fundamentals, he sees the entire yield curve as one example. So he sees the 1 month, the 3 month, the 6 month, the 1 year, the 2 year, the 5 year, the 7 year, the 10 year, the 20 year, and the 30 year. Understanding where money is flowing, so it's flowing into the 2 year, okay, heavily, and understands the flow on the short end and the flow of the longer end. So money's coming out of the 10 and going into the 2. So now the 2-10 spread is changing. So he understands now the spread between these, but he also understands the shape, meaning like the steepness or the flatness or the inversion of the yield curve. So even though none of that is on that risk matrix, he sees it and knows it. Meanwhile, he also sees seasonality, and not just the current month and the next month, but the change between the current month and the next month. So the transition, let's say if there's a peak or valley, you'll see that. So he's looking at this month's seasonality and next month's seasonality and thinking about it. And then taking all of that information and, of course, all the other things like jobs and GDP, inflation, all that kind of stuff, and some technicals. And he's taking all of that and then applying it to what we know to be true in the risk matrix, which is that quantitative analysis of the algorithms, and then thinking about what they mean as a as an aggregate, right? All of this, what does this mean? So he can break it all down piece by piece, but then put them together, and he understands the associations, and then looks at yield curve and understands that association, and then looks at technicals and understands that association, and then looks at seasonality, current month and the upcoming month, and understands all of that, and creates a new score as if he was human, being able to say, I understand where we are now, but I also have an opinion on where we're going. And then creates a new narrative and then explains his thought process. So the difference between the data and intelligence, the quantitative score tells you what is happening. The AI analysis tells you why it matters, what it means for different market regimes, and where to watch and where to watch next. Okay? That's the intelligence. And so that has been created, and I will unlock that for the appropriate levels later today. In fact, it's not even supposed to be locked. And I didn't ask it to be purple and make purple text on a purple background. That wasn't my decision. So I'll get all that unlocked and fixed and everything. But isn't that cool? So now it's like going to your senior manager and saying, okay, I collected all this data, and I think I know what each one individually means, but then when you put them all together, I kind of get lost. And he can say, yeah, well, yeah, okay. Let me explain how this all goes together in a bias. So it's slightly bearish would be his answer or her answer. But then the next step would be to say, well, based on all of this and my 20 years of trading experience, here's how I would fit it into a future narrative. Here's how I think it'll work out in the future. And would be able to justify and the argument with data. So, for example, if it's really bad now, but next month is usually a good month, then you'll say, well, it's really bad now. That is true. But based on, you know, 27 different December, is usually a pretty good month with, with a positive variance of good to great, much more than good to bad. So good to great is more likely. Therefore, blah, 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 blah. So not just up, but what's the variance in the standard deviation in the up, which of course we track now too. So anyways, cool stuff. Cool. You know what else is cool? Our correlation. Now, of course, it's not supposed to be gray background. screenshot. Yeah. I'm just taking a note. So almost done. I'm just taking notes so I don't. Yeah, these things are usually pretty quick to fix. Okay? If you can get her done, get her done. You know what I'm talking about? But anyways, it's correlation, and even though it's hard to read, I can see it, and maybe we'll get this fixed soon. But this line here is the stock market, the S&P 500, and this is VIX. So what do we know? If the stock market is rising, 81% of the time, VIX is falling. It has an inverse correlation of 0.81. 81% of the time, if the stock market is up, VIX is down. Or if you flip it around, if right, you flip it around, if VIX is rising, which is volatility, right? If volatility is rising as measured through the VIX, 81% of the time, the S&P 500 will fall. Well, hell's bail. Okay. Neat, right? So I'm trying to change this background right now as we're talking. So here's how we get into the math of this. I try to explain our logic on every page. I'm not concerned about giving away the secret sauce. I don't want to make what we do proprietary. I'm trying to make you a successful trader and giving you the information you need to make better trading and investing decisions. And if I give you the tools but don't explain the logic, then how are you supposed to get better? Right? So everything is here in writing. So if you're like, man, I don't really get this. All right. Well, it explains it, what the positive correlation means, what the negative, okay, and the range, and the methodology, and then interpretation. What does this mean? What does that mean? Okay. Good. Looks like it's going to work. Cool. So again, why is it slow here? It's because it's not graphics that we're loading. It's actually going into the database, gathering the data and doing the calculation. Oh, it still didn't work. No, it's supposed to. Maybe it is fixed. Let's see this. Maybe I. So correlation. So one thing that you could do is watch the dollar index and then know what you should be looking at to trade next. There you go. So it's nice and clean. Isn't that pretty? Yeah, much better, right? Yeah. Okay. So you can watch the dollar index, which is the Dixie here. And it shows that if the dollar is strong, the S&P 500 goes up as well, but only 33% of the time. Or it goes up, I really should say, it goes up as much, 33% as much. Okay, now the interesting thing about this is that's not what I would have thought. Normally when the dollar weakens, the S&P 500 goes up. Well, that's what I thought. I can't prove that. In fact, I can prove the opposite. If the dollar is strong, NASDAQ has been going up. If the dollar is strong, volatility has been falling. If the dollar is strong, look at this, 72% of the time gold comes down in price. Well, that makes sense, doesn't it? So that makes sense. This other stuff, I just would not have thought. Well, we have the data, so I don't have to think. I just need to now know. If the dollar is strong, 97% of the time the euro dollar falls. How about that? See, the negative number means, okay, if Dixie is strong, boom, euro dollar drops. Now that's interesting because that tells you the euro dollar practically is the Dixie. If the dollar's strong, euro yen goes up. I would not have thought that. That's what it said. If the dollar's strong, high yield investing falls. Junk bonds fall. Now think about it. Why do you own the dollar? Well, usually it's safe haven risk off. Usually. That's not, you can see there's something else going on in the stock market that is unusual. It's unusually bullish, but whatever. But this is right as rain. If the dollar is strong, it's usually a safe haven flow. Now, so how do we define that? Well, high yield junk bonds are not a safe haven. They're exactly the opposite. So when the dollar is strong and we think it's risk off, guess what? Money is coming out of risky bond investment. That totally agree. Okay. Now, with these yields, I've forgotten because I've asked Aiden a couple of times, wait, are you reporting price or yield? So I don't talk about that. And then oil. If the dollar is strong, 57% of the time oil goes up. Now you're like, wait. Does that mean it treads price? No. If there's no correlation, this would have zero. Okay? Like, for example, Gold and high yield junk bonds. There's basically no correlation. One could go up, the other one could go down, and vice versa. There's not a hardcore negative correlation or inverse correlation, because that means if one goes up, the other goes down. Oh, well, then that's tradable information. But if one goes up and the other one doesn't really predict the other, then there's a very low number. Euro, yen, and high yield don't seem to matter. Okay? They don't really, one doesn't predict the other. So you want to look for strong positive or strong negative relationships. Does that make sense? So oil going up when the stock market goes up. That's about 75% relation, positive correlation, sameness. Well, usually, let's say usually, I wouldn't assume such a thing. If oil prices are high, that's bad for the stock. Well, oil's been going up the last 30 days, or at least not down. We've been stuck around this $60 a barrel. And this has been calculated over the last 30 days. So oil's at support. The reason oil got so low down to this $60 a barrel price is because there's been a worry about oversupply. So oil comes down, but then finds a floor. Now, in this more recent period, it just so happens when the stock market is up, oil's gone up almost all, 75% of the time. Okay, well, why? What would explain that? And see, this is now Aiden's job, right? What would explain this? Not just report it. That's a data dump. What would explain that? Well, now the demand side of the equation is kicking in for oil, where, okay, supply is too high, price has fallen. We found support, but now, for example, government shutdown might be over. That's risk on. Okay. Peace in the Middle East, various other things. And what seems to be happening is next year's global GDP demand side of the equation is pushing it up from the floor of 60. So it went down on increasing supply and now seems to be recovering based on an increase in perceived demand. And all of this can be read inside of the data. Can I actually prove that? No. But that high correlation explains something. So the stock market goes up because a perceived increase in global demand in the next, let's say, 12 months. Well, that demand would impact this demand. Euro yen goes up much of the time. What does this mean? Let's say you want to trade the VIX, but you don't have an options or futures account. You want to trade the NASDAQ, but you don't have that in your account. Now, Trader's Way does, but let's just say you don't. Well, you could trade euro yen in Forex and get 75% of the sameness. Now, what I used to do back in the early days of trading was that pound dollar and pound yen. I think pound dollar was 5 pips and pound yen was 12 pips. Spread. But back then they had a high correlation. So in those early days, I traded pound dollar instead of pound yen. Because I pretty much got the same move, but it was cheaper to enter. And back then, as a newer trader, you're worried about every pip because you're so afraid of losses. Well, then later on, I learned, well, wait. The reason pound yen has a 12 pip spread and not a 5 pip spread is it moves more than double. So the average daily range was not 75 pips, it was 150 pips or even 180 pips. So then, wowzer. Okay, so it costs more, but you might win more. Great. So then I learned that. And then I learned the carry trade. Oh my goodness. Okay. But this idea of what if you knew the sameness between gold and a Forex pair? Well, then, so there was a time when I traded Aussie dollar instead of trading gold because back then Forex accounts didn't offer gold. You had to trade gold futures. And I got crushed on my taxes because gold futures and oil futures were taxed differently than Forex. And so there was this one year where I had a 750-page tax bill. Oh my God. Yeah. I'm not even joking, right? So anyways, so what I ended up doing that next year is I found through correlation, instead of trading oil futures, I'd trade CAD, and it was like, I forget the number, but like 0.73, this, positive correlation. And for Australian dollar, it had, let's say, about 80% positive correlation with gold. So they were not actually gold and oil, but they were pretty close most of the time as far as direction. And to really just to keep my tax bill down and to make it simpler, I ended up using correlation like this to move all my futures trading, because I was doing futures and Forex and stock indices, which again were taxed differently and had their own treatment and everything. So I moved everything based on correlation data to just trade everything through Forex. So I remember, for example, the S&P 500. Yeah, it was S&P 500. Yeah, the S&P 500 had a very, very strong correlation with euro yen. Now it's strong, but I wouldn't call it very, very strong. But let's say it was 85 or 90% euro yen went up when the S&P 500 went up. Well, then I could trade what I see on the SPX, but trade it on euro yen, make the same kind of money for the same reason, but on a different asset class that gave me more leverage, gave me a carry, gave me the same correlation, and gave me a better tax treat. Now, do you see why? Now you're like, whoa, dude, that last part, say it again. Yeah, I made pretty much the same amount of money doing the same thing, doing a different asset with higher leverage that actually paid me a carry and gave me a better tax treatment. Well, hell's bells. But this isn't all the assets, because you're like, Wayne, that's cool. You got euro, dollar, euro, yen, but I like the other stuff too. I wonder if oh my God. Yeah. So I'm gathering data. Everything that says NA, I wasn't able to pull the data. So we are capturing the data. So 30 days from now, we'll have the person correlation coefficient for all of these assets that are currently missing. So, for example, you're like, well, I need to know the correlation between Doge and Ripple. Oh, you do? Okay, I'll do that for you. Okay. I'm not going to do this platinum palladium I'm going to switch that out for wheat and corn and soy. Because I think none of you are trading platinum and palladium. I've done it actually. Palladium actually offered me a carry for a while, but those days are over. But we have one member of TRADARS that would use that data: corn, wheat, and soybeans. I'm not sure about soybeans if I can get them, but I know the other two for sure: wheat and corn. And if one member will use it, that's good enough for me. So Lucas, I'm going to add them. All right, so now it's recalculating the risk. Okay, I don't need it. What was that, about 15 minutes talking since I last loaded it? So see, that's too much. That's too much. So I'll have to leave. So bonds, what I did here is I rebuilt the yield curve based on correlation. So the 3-month, the 2-year, the 5-year, the 10-year, the 20-year, and 30-year. And then we looked at junk bonds versus ultra safe bonds. It's kind of neat, huh? Here's the stock indices. And so I put here, I want you to see the VIX and how volatility impacts global stock markets. The kakaran. Huh? Is volatility good or bad for the CAC? So anyways, we'll be able to see all of this. And you're going to find out volatility is bad. And when you start analyzing your own trading performance, you need to understand volatility is bad, and you need to find ways to take volatility out of your portfolio. And the only way is you can take my word for it, which reminds me of Tommy Boy. Huh? You can get a good look at a T-bone if you stick your head up a cow's ass, but I'd rather take the butcher's word for it. So anyways, look, if you just saw it, so how about this? If the VIX falls, okay, stock market goes up. If the VIX falls, stock market goes up. If the VIX falls, stock market goes up. If the VIX falls, stock market goes up. The VIX falls, stock market goes up. Now, not at the same rate. Now, you have to understand that the VIX is actually a calculation off of S&P 500 future. So the correlation is kind of there for Germany and the UK and Japan and France and Australia, but they're not as impactful because that would be our general risk on, risk off. So another way of looking at it is if the S&P 500 goes up, how often does DAX go up? Well, actually, they have almost no correlation. Now, is this good or bad? Well, don't buy DAX just because the S&P 500 is up. And this is important because you hear talking heads on TV that say things like this all the time. Oh, well, the DAX is up today, so the S&P 500 is going to open strong. And you could laugh and say, what a nincompoop. Huh? What a gullible. Because you know better. There's actually none, zero correlation. So if someone on TV says, well, Europe is opening hot, so the S&P 500 is going to pop. Bull hockey. That is not true. Now, they might, but there's no correlation. That would just be random. Now, of course, we're only looking at 30 days worth of correlation. So maybe on the long run over the last 20 years, okay? Or maybe this person knew what they were talking about pre-COVID, but since then it hasn't happened. Well, do you want to listen to somebody that used to know the truth and hasn't updated their knowledge base? So all we have is the fact. So if you look at the last 30 days, just looking at DAX, if Europe is way up or way down, it has no bearing on what the S&P 500 is going to do. They're totally decoupled. There's no relationship. They're not even opposite, which is actually useful. Because you care if it's opposite. Now, what if somebody said, well, Nikkei is up this morning, or was up last night, so this morning S&P 500 could go up. Yeah, now that actually I can prove. But not the DAX. Oh my gosh, isn't that sweet? Is everybody happy with this information? Look at all the right, the details, so that I want to make sure you know what we're doing and the thought process behind it and our calculations. I want you to know everything. This is not a proprietary, get you hooked on data crack cocaine. And you're like, I can't trade without it. No, I don't think you'll want to trade without it. But my number one goal, since most of you guys have known me for a decade or even 2 decades, you know what's behind the wane. I want you to become a better trader. So if that's my number one goal, I have to share the secret sauce with you. That's the recipe to Coca-Cola. Oh, you like Coca-Cola? Here's the recipe. You could do it now without me, but wouldn't it be nice if we stayed friends? So anyways, pretty cool stuff, huh? Going back to the risk matrix, if we now look at 1, 2, 3, 4, 5, 6, 7, 8, 9, 11, 12, 13 different on 3 time frames, weighted individually. All right. That's many hundreds of potential outcomes if you looked at them individually. Now, if you looked at them subjectively, which is more of saying, instead of just looking at them as a number, you looked at them holistically. And the relationship between them all. What does the relationship suggest between risk on and risk off? And then add forward-looking guidance like seasonality in the next 2 to 4 weeks, not just this month, but this month, now, and next month, and look at that relationship. And then read the market and read the assets and read the trading and read the flow. Now we're talking about thousands and thousands and thousands of variables. Versus our old method, which was 24. We went from 24 to thousands and thousands and thousands. So I need to explain, this isn't like I upgraded the color, and that's the big change. We've increased the complexity from 24 possible outcomes to thousands of outcomes, not just based on quantitative data, but the relationships inside the quantitative data. Much different, right? Much different. And it's similar for me. It's like, here's the data. This would be, it's all statistical analysis, right? So you just program an algorithm. You'd capture the data. So you'd have to have 30 days worth of these prices, and then just say, run a Pearson correlation coefficient over it and give me the data. Okay, that's quantitative, but it's also an algorithm. It's mathematical. Now, when I say, ooh, if you look at the relationship of oil and the stock market, and I see the correlation coefficient of 0.74, I can say, well, I remember in the past, which an algorithm can't do, that's unusual. Usually oil goes up and the stock market comes down. But I also know oil prices are very, 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 very low based on supply. So therefore, if we have a positive correlation coefficient with the stock market, then they have a relationship between the two, or it's random. But then I understand that we're on support, and I also understand through my own personal research, but also the data inside of TRADARS, that the market is starting to trade an increase in global GDP next year. And that in of itself would push oil from being at support to up. It's certainly not going to push it down. Increase in global GDP would push it up. So I could say, well, this actually over the last 30 days, this correlation is pretty high. In fact, very high relative to the historic norm. And that must explain for both. Both are trading on this assumption of an improving GDP outlook or future GDP. Or, and maybe it's future Fed cuts, which would then increase GDP. Or the government that's currently shut down reopening. But that's very, very today. It's hard to, you can't really get that into the correlation numbers. That's why we look at 30 days. But maybe that will only continue to strengthen this current relationship. Now, that is not quantitative algorithmic programming. That would take intelligence, right? Now, that's something that I would see. And I would say, ooh, look at that. And once you know this, currently, you could be trading oil along in the same direction as the S&P 500. 74% of the time, they go in the same direction. So if stock market's down, WTI is down. If stock market is up, WT is up, or vice versa. If WTI is up, the stock market's up because it's trading on GDP. But now you're like, I have to be able to understand the past and then look at the relationship between the two and try to discern what that relationship is. And that's what the AI can do, because I taught AI in our own large language model to spot such things. Now, will it look at that and see it the way I just saw it? No, but it's capable of such relation. It might notice something that I missed. Okay. Notice that a lot of these things make sense. Stock market goes up, dollar gets strong. That doesn't make sense. Yeah, but you see over here, euro dollar falls, and about the same amount. So there's definitely a strange relationship going on compared to what I believe is to be normal, meaning stock market up, dollar down, euro dollar up. But it says stock market up, dollar up. And I'm like, that doesn't make sense, but euro dollar down. Well, if this one is happening, then this one would happen. And so it now has confirmed itself. And I don't think that's normal, but it is. It just is. And now you know the truth. Veritas. Huh? You have the power through knowledge. You see? The power through knowledge. You are the most powerful trader in the world. Yeah. So my focus is going to be on the fundamentals, especially if the government's going to reopen. I got to get this ready for that. So this is what I'm going to focus on this week. But I just want you to see and fully appreciate that risk. Let's do some technical analysis, and then I'll get you out of here. What do you want to do today? Swissy pairs and yen pairs. Okay. And euro dollar. Okay. Dollar pair, yen pair, Swissy. Okay. Which is good because I actually did this at traders.com this morning, but we used the implied volatility tool to burn through these same assets. So now we're going to burn through the assets, but using a different tool. One that's not looking at implied volatility, but instead looking at patterns, which is a different implied, right? It's just not implied volatility. It's implied price action. Okay, so let's take a look at our implied price action. Pound dollar, bullish with an opportunity. Aussie Swiss franc, neutral or sideways or consolidated. Kiwi dollar 4-hour chart, bearish with a threat. Kiwi Swiss franc daily, bearish with an opportunity. So how do you rectify these? Up to down, and then the down to follow through. So according to this, we're on our way to 43. Cool. Euro dollar daily. Well, it's bearish. That's that. It is bearish. And it's under threat because the leg is up. So if you want to be a bear, okay, either the top resistance line where the arrow is pointing, or the moving average where we are now will end up being your resistance. So if you're going to be a bear, get ready to sell later today. And if you're a bull, well, you don't have a bullish trend, so pass. Pound yen daily chart, it's bullish. Okay. And it looks like it's not breaking out, so there's probably an opportunity on their way to 207. Kiwi Swiss franc daily. Yeah. It's saying here, be ready for a double bottom. Swissy yen, bullish with a threat. Aussie dollar daily, it's consolidation. USD CAD, this is an up channel showing US dollar strength over the Canadian dollar. And it has been pointed up, and we've already achieved that. So I would say more likely the day this ends up being a threat, you might want to look for a role reversal and kick it off the daily moving. There we go. That's it. So again, one of the major benefits of using TRADARS is just a time save. So we just looked at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 times 5 times. Okay, that's 60, isn't it? So we have 60 charts now that we just looked at. But there's up, down, and sideways pattern. So 60 times 3 is 180, right? Yeah, but inside of that, then there are different types of up patterns, different types of sideways patterns, and different types of down patterns. And also we had reversal patterns in there. So, okay, look, now we're like, they're out of what we just did. There were hundreds and hundreds and hundreds of potential outcomes. Now you do that with your brain as you burn through charts and you're going from one chart to another. But the thing about the human brain is it's not very good at such things. And so what we did is before we even looked at a chart, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay? 10. Yeah, I'm working on that. I'm working on the sign up process. In fact, yeah. All right. So we boiled down just on these Swissy pairs, yen pairs, and dollar pairs, something that had hundreds and hundreds and hundreds and hundreds and hundreds of variables, various potential outcomes. And we boiled it down to 10 charts. And then the 10 charts total took about a minute and a half. So you have to understand that we went through 500 charts in 90 seconds. The thing is, 490 charts were not worth would have been 490 of the charts would have been a waste of your time. So now it's like, look at these 10 charts. And if you understand the patterns, you understand the meaning. And if you have a bias, so let's say I want all dollar pairs to go up. I want the dollar to weaken. I want the Swissy to weaken. I want the yen to weaken. So I can look at this maybe later, let it reverse. So not now, not now, not now. Yep, this one might be good to go. Not now, but soon. Yep, this one's good to go. Yep, that one's good to go, but I should be cautious. And this is consolidating at the bottom range. I think I'll pass done. Because I also have a bias set on my fundamentals. And the other 490 charts are not even worth my time. If I thought we were not going to be trending today, if I thought we were going to have a range day, meaning it's not going to be a dollar, yen, or Swissy move, it's not going to be a risk on move, it's going to be relative strength move, I would turn those assets off and I would just do cross pairs only. Okay? Because I'm a macro trend trader first. And I believe throughout the day, the market is going to start betting on the U.S. government reopening soon. And if that's true, we're going to have a trend. That's why I would, and I'm a macro trend trader, so I don't always start with dollar and yen and maybe Swiss franc, but definitely every day, dollar or yen. Am I a buyer or am I a seller? But there are market conditions in which that macro trend won't appear. Maybe it's seasonal, maybe it's just market conditions. And so therefore, those are the days to be trading cross pairs. So if I discerned that's the kind of day that we had, then I would bust this out. Okay. Yeah. And then these patterns should mean something to you. You should be able to look at these and do your relative strength exercise by eyeballing the patterns, but also being able to very quickly look. So again, these are 5 different time frames. This is about 60 charts that I whittle down to 3, 6, 9, 10, 11. So there's 60 potential charts, dozens of potential patterns, and there's 11 things I should consider. And then from that, with my bias, I could read, are they opportunities or threats? But I can also read, Kiwi is very weak. And so maybe I want to get on that. Okay. Like there's a lot of ways to read this. Okay. So now I write down my to-do list, my trading list for today. And then I can go to my Trader's Way account, pull up MT4, and now do my technical analysis. So this is all about your daily routine and making good decisions before you even open a chart. What do you think about that, huh?
Feds Musalem, U.S. economy pretty resilient.
Austria production index contracts 1.7%.
Contracts.
Australian dollar US dollar technicals. Australian dollar US dollar moves higher, helped by risk on sentiment.
Feds Musalem, uncertainty has plateaued.
Technology and consumer cyclical sectors shine amid semiconductor surge. Yen underperforming on sentiment, Scotiabank. Pound tentatively extending last week's recovery, Scotiabank. Euro quiet and consolidating last week's recovery with support from spreads, Scotiabank.
All right, so yen underperforms on sentiment. What the heck does that mean? Yen is weak. Why? Because the world thinks poorly of the yen? No. The sentiment is risk on. We had a Fed, right? We had a Fed speaker say, hey, uncertainty is plateaued. We should be in the free and clear plan to do whatever we want to do in monetary policy without worrying about all of that. Great. Right? Technology and consumer cyclical sectors shine. Semiconductors surge. All of that says risk on. Aussie dollar is up. That's helped by risk on sentiment. See, risk on, risk on, risk on, risk on. Yen is weak. Yeah, boy. So would I be trading a cross pair under this circumstance? Heck no, I wouldn't even consider it. Wouldn't even consider it. Yeah. And so now you have the data. You is smart. Going out to our vol calendar, and then I'll let you go. Okay, tonight we got news in Asia. Tomorrow morning we have both UK jobs and German zoo. GDP out of the UK. Way out on Thursday. So it's a quiet week, yo. Peace on earth. May the pips be with you. May your profits be above average. Thank you very much, Traders Way. We love you, Traders Way. Yeah, let me check my carry. Yeah, got 85% in carry on a $100 investment. Cool. Free money. Cool. So since July, I made that trade in July. Since July, I've received 82% of my money back. Plus, I got all those profits. Lovely. I'll see you at noon, traders.